It is almost year end. So inventory is one of the things for retail businesses, restaurants, manufacturers. So it is a big deal to get that counted right. And in this webinar, we will just talk about ways to do it and how that impacts you on the bottom line. So let me kind of give you an idea about inventory. And if you are a business that you resell things, so number one, you resell without much of a touch. You resell simply, you simply resell what you bought. Say you bought a candle, and then you resell that candle to mark up a 20%. So that candle is your inventory. And there's another type of inventory like a restaurant. The restaurant has inventory too, right? The restaurant inventory is you buy vegetable and then you put in labor and then you present that as a dish. That's inventory, okay? And then you also have manufacturing. They use inventory. For example, if you got fresh meat and you want to make it a barbecue meat, then you go through drying, you go through seasoning, and you do that, right? So those are same thing. And you are actually making something out of the stuff you bought. So that stuff, that is inventory. And there's two ways of valuating inventory. And when you at the year end right now it is the time and for you to I know I'm not sharing my screen, but that's okay because I want you to understand the inventory value and what is inventory right now. Then I will share with you my screen on things that I want to talk to you about. So the inventory value, when IRS come to you and said that, what's your inventory value? And your answer to that question is not about how much you will sell that inventory. It is how much cost you to get inventory. So for the restaurant, even if their dishes is $50 a plate, but the piece of meat they bought as inventory is $8, let's say. So when IRS come around, they want to know how many of $8 you have in the storage. So you look at your meat, don't think of the plate, but you're thinking of how much you bought it as a raw material. Okay. But what if you are a factory and you are actually doing beef jerky and you bought the fresh meat and you go in, dry it, you're seasoning it. So 1 pound of meat become 1 ounce of beef jerky. And in that process, when you account inventory, not only the meat, and you also need to add in the cost of maintaining those meat in your storage room. So that is what we call the allocation. And you really want to be aware of that just in case you are a restaurant owner, but you're actually selling something a little different than a plate of food. You're selling something more like by pound, and you're selling the barbecued pork, and you're doing manufacturing on that end. If that ever happened to you, you probably was accounting your inventory, accounting your expenses wrong, and for all these time, because there's not a lot of people really paid attention to that. And there's also retail store, and we just sell what we bought, and we wrapped it with ribbon and we sell to client. And those kind of inventory, and when you are counting them, and one of the key is you need to know how many of those you bought you really don't have any hope to sell. And you bought too many, or that, boy, as soon as I ordered my inventory, something else came up. Really, clients are not buying this anymore. They're buying something else. So your inventory, you bought it brand new and really in a good condition, but you cannot sell. So these are the things we are going to cover today. And also, I want you to know that inventory counting happens at year end. Your year end do not have to be December, right? Your year end could be in June. Your year end could be in November. So just make sure that you count your inventory at year end. Then, and I have a couple of advices in terms of before you get on your knees and accounting inventory and what you need to do. And number one, I really need you to, as a business owner, I need you to tidy up your inventory. When I say that, what do I mean? I don't mean that for you to go to count inventory. No, I just want you to put inventory of one type in one place, the other type in the other place. So I want you to have a clean floor. So when people come in to count, they know that, oh, that's the inventory, that's how it laid out. And how do you have a clean floor? You want to separate the one you can sell, you want to separate the one you cannot sell. Because the one you cannot sell or occasionally sell, or some crazy customer come in wanting to buy it, and you are even thinking, why are you wanting it? But okay, fine, you can buy it. So if that is that type of thing, you want to make sure that you put them aside, because let me tell you why. Because you don't need to count them. You only need to count the one that you will resell. You have a hope to sell. It's still available to sell and is in good condition. So clean up your inventory, number one. Number two, and you want to invest in tools. And if you have a small businesses and you don't need to buy the counting machines or the scanners, no, you don't need to. But if you have a sizable operation, when I say sizable, I will tell you for retail store, if your total annual sales is over 800,000, you should use inventory tools. And you just type in on internet inventory tools, there's a whole bunch of them coming up. And if you found them and you don't know which one is fit for your business, and you can either come to us or you can call them. Say, hey, I have a store for $800,000 sales. I want an easy inventory counting tools, and what is it? So it is really, those kind of tools is like your extra hand. It's like I call the computer my extra brain. I couldn't remember all of the things I need to remember. So my extended brain is my computer. And your extended, inventory counting tools is those tools, is becoming your part of your hand. So that's your extended hand. Some business need to be audited every year. So those business, you want to make sure that when you count inventory, call your auditor. Tell your auditor that, come on in, I'm counting inventory. And so they would save so much of their time. It will save your money too, because the auditor charging you by time, right? So you want to make sure that you know to call them. And I'm not talking about IRS auditors. I'm talking about the auditors like our firm. We would audit the companies, so issue financial statement, and sometimes they are public traded companies, or they are not, just because the shareholder wants them. So I'm talking about those accounting auditors, not IRS auditors. And hire third party to work on inventory. Inventory accounting doesn't need to be your job. You can literally contract with your CPA firm, contract with us, and we will send two people to every location and to count inventory. If you don't hire someone, make sure you have two people counting inventory. I say two people, unless you yourself, you're a business owner, you can do it yourself. If it is not, it always should be two people. And two people, why two? One is going to record it, the other one is going to count it. Two of them will reconcile. So that's how typically people do. And write off the unsellable item means pull them out of the shelf, stuck them in the corner, and don't throw them away, because you might have crazy customer wants it, but you want to just make sure that you don't count them, because they don't need to waste your time. You just count the real inventory. And now, after we understand this inventory counting, all these nitty-gritty ideas, then you probably ask me, oh, Ying, what's the big deal? I mean, I can just tell you that it's $3,000 and that's it. And no, that's not good enough. Let me tell you why. When you get audited, the auditor asks you, hey, do you have Do you have a year-end inventory number? Do you have anything to prove to me? You go, oh, I just told Ying that $3,000. That's all. I told my accountant. That's not good enough, folks. You want to have an inventory counting, you have a way to do that easy. And then let me share with you something right here. And because I want you to know that you can actually do inventory counting really, if you are a small business, you probably feel stuck because everything people talking about, you're like, that's for big business, not for me. And let me show you something. It is for you. So I opened up a drawing board and I hope you can see my board. So let's say I have a retail store. Okay. This is my retail store and my cashier is right here. And I have a door here going in, door here, come out. So all of my inventories are here along the wall. And I also have aisles inside of a store, just like that. Each aisles are back to back. So customers go into here and go into here, shopping on both aisles, right? So typical. And you know what? I am so small. I have no warehouse. When I buy something, I put on shelf. I never have anything. I don't have any secret place outside my store. And here is customer parking place. And so I don't have anything. It's all here. If I don't have it on shelf, I don't have it. Perfect. So at the year end, you know what you do? You're gonna look at this aisle. Oh, this is veggie aisle. Look at this aisle. Oh yeah, this is the kind of a fresh items like things are need a cooling, but it's open doored cooler. So in here, those are coolers, and I have meat things, everything in here. So as long as you have a category, you know how much would cost you to have this amount here. So you may say this cooler is shrimp and high value seafood, so it's 5,000 left over. This one is 1,000 left over. And so you have price for all your aisles and your space. This one, you will date that on December 31st, 2020, and you will fax that to your CPA firm. And this will become, okay, I have inventory of 10,500. And how did you know? I know because those aisles, I know how much they were. Okay? You will never find anybody to give you this answer, but you find it here because our firm, we have done so many audit representation, and we work for our clients. When IRS audit them, they don't have inventory counting. They don't even know what that means. Then we actually draw these shelf out. We give to clients saying, think about what you have, and this is where your stuff is at, and immediately our client knows how much on each of these shelves because they don't really understand the requirement of inventory count means exactly what. And of course, if you're running jewelry store, don't tell me that you're gonna be combining that the whole thing up and say that's what value. No, high value item, you of course should have a very clear count. But in this particular example, like groceries and fresh produce stores, and the things are just on the shelf, selling every day all the time, and the turnover is really fast. That's the way to run your inventory. So I come back to my point by saying that inventory is a thing that you just need to have a record, and the more inventory you have, I want you to hear this. I say this all the time when I do webinars. As soon as I mention about inventory, I want to nail this thing in your head. You would remember that 100%. The higher of inventory you have, the higher of taxes you would pay. Simply because when you have inventory, that means you spend the money, but you haven't sold it yet. If you haven't even sold it, you can't count as expense, because your expense can only come from the inventory that is sold. So the one is not sold is almost like your asset. It is your money, and you didn't really use it yet. So inventory doesn't get converted to cost of goods sold, then you don't have a deduction. That's why if you are a store, let's say if you are a novelty store selling Christmas ornaments, okay, and you bought a lot of inventory in before in early December, and so you have a lot of inventory coming in, and then those inventory, you didn't order them right, they didn't get sold, and that inventory is actually cannot be cost of goods sold unless you determine they are outdated and they are not sellable next Christmas. Then you can bring everything in as cost of goods sold. So the idea is your inventory really need to be on your balance sheet as useful. If it is not useful, write them off, because that's what meant to be. Inventory are the thing with values, meant something to you. If it doesn't, it's just a you're hoarding those stuff and you just feel bad, don't want to throw them away. That's not your inventory. That is something you don't want to sell. You can still write it off. Something you couldn't sell, nobody wants it, you write them off. So that way they become they stay in one place because they're not your inventory anymore, but they're still available to sell. Okay, so make sure you understand the concept between inventory and stuff, right? That's the key. Of course, so with inventory value being high and your cost of goods sold is low, so you will pay more taxes because your profit is higher. On the other hand, if inventory amount is low, your cost of goods sold would be high and your profit would be low. So as a result, and you will pay less taxes. Makes so much sense, am I right? So don't look at inventory thinking, well, why do I even need to care about that? Because inventory is inventory. My accountant said inventory is on balance sheet. This has nothing to do with income statement. No, it has so much to do with the income statement. If you are in if you are in the perishables industry, and you really need to make sure that on December 31st, everything you reported on inventory are not going to expire already, because you really should not be selling expired goods, right? And of course, there's some stuff expired. I use expired stuff. I think is perfect condition, and I don't normally give a lot of value to those labels, but in theory should be thrown away because your customer may not want it, even though you can use it, right? So that is about inventory. Now let's talk briefly about if you actually operating some sort of factory, not in the big scale. You have your restaurant, but you are doing cha shao, right? That's a Chinese term for those barbecued pork. And those cha shao is the same thing. They actually come in as a fresh meat. Then you dry them, then you seasoning them, then you sell them by weight. So if you do a lot of that, and your cost of goods sold and your inventory should have a share of your facility cost. So let's say if you bought 5 pounds of fresh meat, and then part of the fresh pound, the fresh meat that you buy, they really need to be maybe cooled in certain area. Some big factories, they have a whole warehouse is 4 season temperature controlled, so they can dry their meat in there. So those kind of things would allow you to deduct, to have your inventory cost to be changed with the overhead charges. So your inventory value is not just inventory you bought for, but it's also other costs you can tap onto it So when you write them off, it's a bigger amount to write off. So that's in the manufacturing. When if you have any questions related to that, that deserves a separate conversation for sure. And now someone was just asking me, and if I wrote off an inventory, and say I wrote off a chair, this chair is so outdated. I bought it 10 years ago, trying to resell it. Nobody wants it. It's gathering dust, so I write it off. So you just wrote off the chair. The chair has zero value, right? It only showed up in your warehouse, but it's not on the book, okay? Because we wrote it off. Now, a crazy customer coming in, want nothing but that chair, and not only wanting to pay you what it cost, and also pay more. So you got $300 over that chair you don't even have value for. And in that case, that $300 is 100% gross profit, right? Because you wrote it off. So hear me on this one. Don't be afraid of writing off inventory. It is not equal to you throw your inventory away. It is not in the dumpster. No, it is actually in your store, need to be sold, possibly can still be sold if you got a crazy one coming in. But when you sell it, you don't have a cost of goods sold to go with it. It is a item that you made money 100%. So that is the difference. It only shows up on your book. So if in the year you only sold those items that you wrote off, boy, you will be like your sales would equal to your profit because you have no cost of goods sold, right? So that is where I want you to have a come to term with inventory write off. Don't ever be afraid of writing off inventory. So that is kind of the overall picture I want to paint for you today related to inventory. And we have 30 minutes scheduled for that. And we have 4 minutes left. So I'm actually going back. Let me stop sharing. And I want to see whether we have any questions coming out. If not, and we will just conclude it here. I think you got my idea. Count inventory, and the higher the inventory you have, the more taxes you pay. Don't be afraid of writing off inventory, and the more you write off only means that you made decision. Those inventory is no good. And of course, don't be afraid of IRS come around goes, oh no, your decision is wrong. I think it's good. They will never do that. IRS do not come to help you run your business. And I mean, I would be happy if they come to run your business because you won't need to pay them. They just be in your store helping you running cashiers and do everything. That's actually labor for a couple of days is not a bad idea. But the thing is, they won't. Okay? So they want you to make your own business decisions, sound decisions. So when you write off, you better have a reason to write off. And maybe for all kind of reason, out of trend, and never sold. Christmas is already done, and we don't our prior year Christmas item doesn't get sold in the next year. We get new ones all the time. So things like that, and you know what to do. Write them off and have your taxes be prepared properly instead of having bunch of inventory sitting on your balance sheet and paying bunch of taxes. So that doesn't sound really right. And I also showed you how to chart out the inventory. And we literally have done that to defend our client for audit. And we successfully passed IRS and they accepted our drawing. And I know that's how it was done. So with that experience, I say, yes, you can do it. So, and let's conclude right here. I'm so glad you're here. Hopefully you can pass on the word and let people know that we talk online. Okay. Talk to you guys. Bye-bye.